morning.
Morning.
Good morning. I am the
Good
Registrar
morning.
Clerk for this morning. Chief
Good morning.
Justice, Justice Councillor or online. I call the matter of Clicks Retailers, PTY Limited, and the Commissioner for the South African Revenue Services for hearing. Council are now invited to place themselves on record. Please note that this hearing is being recorded.
May it please the court, I appear for the applicant together with Mr. Olivier.
Thank you, Mr. Bloomberg.
May it please the court, Chief Justice, I appear for the respondent in this matter together with my learned friend, Mr. Molia.
Thank you, Mr. Ellis. Mr. Bloomberg.
Yes, thank you, Chief Justice, members of the court. There are two issues that present for determination. The first of these is jurisdiction and leave to appeal, where the applicant seeks to engage the court's extended jurisdiction under Section 167 3B2. The second question is the merits question. If leave were to be granted, there is only one question on the merits, and that is whether the applicant's loyalty program satisfies the requirement of contractual sameness in Section 24C2 of the Income Tax Act. Before we can arrive at those two main topics, we must touch on the individual requirements of the section of Section 24C and illustrate very briefly how these apply in the context of the applicant's loyalty program. To come to those requirements, we appreciate that the text of the section can be paraphrased or parsed in more than one way, but we suggest that for present purposes, a logical presentation of the requirements of Section 24C is into three requirements. The first of these is that the taxpayer must receive income in terms of a contract. The second is that the taxpayer must be under an obligation, a contractual obligation that results in future expenditure within the defined meaning of that expression. Those first two requirements that we've identified are, if the court will, the two sides of the Section 24C2 equation. The third requirement is that the income and the obligation to incur future expenditure must meet a requirement of contractual sameness. There must be a match-up between the income on the one hand and the future expenditure on the other. None of that is contentious with respect. The factual basis for the applicant's claim to the allowance under Section 24C is this. For every rand of income that the applicant receives from a loyalty program member in terms of a reward-generating purchase transaction, it is obliged to return 2% of the transaction value to the member concerned in the form of free or discounted merchandise. That's the factual basis of the claimed allowance, and that fact is common cause. We see that in paragraph 17.4 of the stated case. If we come then briefly to touch on the three individual requirements against that backdrop and how they apply to the loyalty program, it is along the following lines. To start off with the first requirement, the receipt of income in terms of a contract, it is important to appreciate with respect that when we say, as both parties do, that Clicks earns income in terms of a contract for purposes of the section 24C, we are speaking specifically and exclusively about income earned from reward-generating purchase transactions under the loyalty program. We are not speaking about the applicant Clicks' general income. It is not the applicant's case in claiming the allowance that its general income is being used to finance future expenditure. Its case is that the income it receives specifically from reward-generating purchase transactions under the loyalty program is being used to finance future expenditure. And that is the only relevant income we stress for purposes of Section 24C. We see this recorded in the stated case in paragraphs 22 to 24 and 31. Just to touch on that for a moment, paragraph 31 is the agreed quantum table that sets out in rand terms the income that is the subject of the claimed allowance. Paragraphs 22 to 24 of the stated case make it clear that that income is loyalty program income, or perhaps put more specifically, that income is generated by purchase transactions under the loyalty program. We say that is an important consideration given the very exercise that Section 24C compels, which is a contractual matching up exercise. Coming then to the second of the three requirements we've identified, the obligation to incur future expenditure, we can be brief with this. We start off by stressing that it is not in dispute in this matter that the issuing of rewards under the loyalty program gives rise to an obligation on clicks to incur future expenditure as contemplated by the section. We accept that, and we give the reference in the record in paragraphs 34 and 82 of our heads, the reference that is to the stated case and the minutes of the meetings where there was an abandonment of a proposed amendment by SARS. We appreciate, Chief Justice, members of the court, that we have been repetitive about this in our heads, about making the point that future expenditure as contemplated is not an issue. But that was by design with respect, because this aspect of the case became somewhat muddied in the judgment of Wallace J.A., and we say that with respect. In paragraphs 29 to 31 of the judgment of Wallace J.A., which is the heart of the judgment, the learned judge explored a particular line of inquiry. That line of inquiry was whether the loyalty program gives rise to any expenditure as contemplated by Section 24C. That was at the heart of that judgment. And we point out that that question, that line of inquiry, one, is not an issue on the stated case, and two, is one that SARS had at an early stage considered and expressly abandoned. We read SARS's heads before this court as containing a recognition, quite properly we suggest, that this aspect of the case, expenditure, future expenditure as contemplated by 24C, is not an issue. And we refer the court's attention to 3 paragraphs of SARS's heads in that regard. They are 20.3, 37, and 39.4. We needn't go there for present purposes. The upshot of this is that when it comes to the merits, the question is narrow. There is only one question on the merits, and that is whether the income in question under the loyalty program and the future expenditure in question satisfy the requirement of contractual sameness as it was laid down by this court's judgment in Big G. That brings us to the first of the 2 main topics, leave to appeal. Section 167(3)(b)(2) requires that we formulate for the court's consideration the question of law that in our submission arises. Of course, for us to do that, we must preview the merits to some extent. We'll do that briefly. One of the themes in our heads is how the 2 contracts concerned in this matter, the loyalty program agreement on the one hand, and the individual reward generating purchase transaction operate together. We suggest that that combined operation of the 2 contracts is recognized in both judgments below. And as we have explained in our heads, the obligation on clicks to incur future expenditure arises through the combined operation of the loyalty program agreement and the individual reward generating purchase transaction. To elaborate on that for a short moment, We have the loyalty program on the one hand that imposes a general obligation on clicks to issue rewards as and when qualifying purchase transactions are made and to redeem those rewards. But it is the individual reward generating purchase transaction that creates the specific obligation to issue a specific number of points, which thereby creates an obligation to incur future expenditure in a quantified amount because each point so issued has a predetermined rand value. So with that background, and coming again to the position under 24C, the position is this.
Before you say what the position is, the 10 minutes has expired, Mr. Bloomberg.
I'm grateful to you, Chief Justice. The position under 24C, we say, is this. The income is received in terms of reward generating purchase transactions concluded under the loyalty program. The future expenditure is produced by the combined operation of the loyalty program agreement and the reward generating purchase transaction. Is the requirement of contractual sameness met by a contractual structure of that nature? That we submit is the question that this case.
Mr. Bloomberg, how does the reward generating contract impose a future obligation? How exactly?
Justice Madlanga, when a qualifying purchase transaction is concluded, the quantum of the purchase transaction determines the number of rewards issued, the number of points issued. For instance, with reference to the example in the record, there's a 60 Rand transaction where a member swiped his card. That results in the issue of 12 points. Each point had in 2009 a 10-cent value. So that transaction gave rise to the issue of rewards to the value of R1.20. At a future date, when the rewards are redeemed, clicks must provide the member who earned the rewards with merchandise to the value of R1.20 at no cost to the member concerned.
That's not answering my question. All you are doing is to tell me how the system works. But how does that contract create the contract of sale? How does it create the future obligation? How does that contract create? Because that is the income earning contract. How does it create the future obligation?
Justice Madlanga, perhaps a different perspective on the answer that I've attempted to give. If there is no income earning transaction, if there is no qualifying purchase, there is no obligation to incur future expenditure. And it's for that reason that we say that the two contracts operate together. It's through the issue of points, or perhaps I can put it this way. If there are no points, there is no future expenditure. If there is no income earning transaction, there are no points.
Which contract says all of the things you've just said now? Is it not the club card contract?
We accept, Justice Madlanga, and we don't quibble with this, that the source obligation to issue points, the source obligation to reward the points is contained in the loyalty program agreement. What we say
that is the contract that creates the future obligation, the club card contract, the club card contract.
Justice Madlanga, I think that is where our position diverges with respect, because without
I want an answer. Is that not the agreement that creates the future obligation?
It does in part. It does in part, but we say that the obligation is incomplete.
Tell me the part that doesn't.
There's no Rand value. Without an individual purchase transaction that issues points, there is no future expenditure.
No, that's a conflation of issues, Mr. Bloomberg. That's a conflation of issues. All that the reference to the contract is or amounts to is a term of the club card contract. The club card contract says, if you buy for not less than 100 points within a, what period? I forget now the term. Qualification period, I think.
The Form 1 period, yes.
100 points, yeah, not less than 100 points within a qualification period. You are entitled to a discount. So the reference to the sale contract is a term of which contract? It is a term of the club card contract. Let's not confuse. And then that same contract, the club card contract says, I as Clicks have an obligation to give you this discount if you meet these terms, that is at least 100 points within a qualification pro. And what contract says this again? It is the same contract, the club card contract. So the reference to the other contract is merely a term of this contract, the club card contract. How, just, I want you to make me understand how the other contract, the contract of sale, creates an obligation. How? The interlink, I understand. There is a very close interlink, perhaps even closer than the interlink that we were concerned with in Big G. Close, but Big G goes further. It says sameness. So it's not just an interlink, and it doesn't matter how close the interlink may be, sameness. Is it the same contract? So I've said to you, term of the contract merely refers to, but the reference is merely a term of the club card contract. Obligation that I as Clicks will give you a discount is in which contract? It's in the club card contract. Now show me how the obligation arises from this contract of sale.
Justice Madlanga, I don't think I can do better than refer to the formulation of the expenditure in the stated case. The stated case formulates and perhaps I should take a step back. Our starting submission, as per our heads, is that the two contracts operate together. And perhaps that is a different way of saying that there is an interlink between the two, to start off with that. But I would like to attempt to, Justice Madlanga, answer your question more directly. And it goes to the point of there being an interlink between the two contracts, which is our case. On the stated case, and I'm looking at paragraph 21, the formulation of the future expenditure, and the formulation it comes from SARS's letter of assessment, is that Clicks incurs the future expenditure in that on redemption of the reward, Clicks supplies the member with goods equal to the value of the reward. So there's an obligation to incur future expenditure in a specific amount of money. It's not an unquantified obligation. It's to incur future expenditure in the amount of the reward. We say that the amount of the reward, and hence the amount of the future expenditure, is determined by the purchase transaction. We accept that the origin obligation, if perhaps I can put it that way, are rooted in the loyalty program agreement. We take no issue with that. We stress that there's a link between the two, because unless they operate together, unless you have both of them, there is no future expenditure. And we say that the stated case makes that clear with respect.
No question, interlink there is. I mean, I doubt that anybody would ever suggest that there isn't. But once Clicks affords or does afford the club card holder the discount, all that it is doing, I think, is to meet its obligations under the club card contract. That is the obligation it is meeting. It is not meeting the obligation imposed by the contract of sale. Interlink there is, and all that I'm hearing you do is to emphasize that interlink, but that is not enough. It is sameness. Sameness. Is it the contract of sale, which is the income earning contract that imposes the obligation? Advised, I don't quite see how.
Justice Madlanga.
Answer, I will leave it at that for now.
I'm grateful, Justice Madlanga. I expect that in continuing my argument, there are going to be further aspects that relate to your question, and I'll come to those presently.
May I just say this, and perhaps invite your comment on it. How I see the loyalty program is that in a loose sense, very loose sense, but which may well be something totally different to what Section 24C envisages. In a very loose sense, one could say that the club card contract does, in a sense, contribute towards the earning of income by clicks, in the sense that clicks will now have, again, very loosely, a captive market or a captive clientele, because somebody who holds the clicks card and who doesn't hold, for example, a Discam card will say, it makes sense for me to go buy at clicks than at Discam or at any other similar outlet. And in that sense, clicks sales are then increased. So in that very loose sense, the club card contract, what's going on?
We can hear you, Justice Madlanga. We just can't.
Let me just, it says you cannot start video or something because the host has stopped it. This host must please sort it out. Anyway, let me continue. So my point then was, so in that very loose sense, you can say there is a connection between the generation of income and this marketing strategy. But all that it is, as I say, is that it is a marketing strategy. Just like any other, an effective advertising campaign may contribute to an increase in sales, but it does not give an entitlement to a Section 24C discount. It doesn't. But of course, I accept that there isn't that same kind of link as there is with the club card contract. But the short point I'm making, Mr. Bloomberg, is all that the club card contract is, it is a marketing strategy. That's all it is.
Justice Madlanga, we accept that is certainly the commercial objective of the loyalty program, is to drive sales, that there's no doubt about that. We accept too, and I don't want to repeat myself, where the origin obligations are. At the end of the 2009 tax year, Clicks had an obligation to incur future expenditure in the agreed amount that one sees in the stated case. It was 36 odd million rand in round terms. Our submission is that that future expenditure came about due to the combined operation of the loyalty program agreement together with individual purchases. We say that if you think...
Mr. Bloomberg, if you look at para 17 of the SCA judgment, volume 5, page 466, on this particular argument, the court said, in any event, even if the court were minded to adopt the Clicks approach and hold that the club card contract, together with the first sale of merchandise, give rise to the income, this would not bring the case within Section 24C. The reason is that this income would be used to finance the acquisition of stock for future sales, so that the expenditure would be incurred in performing clicks obligations under the club card contract and the second sale agreement, even on a linked basis. The contract is not the same contract. What do you say to that?
Justice Mhlantla, that stresses the value of what we refer to as the redemption transaction. That is when the member presents the rewards earned for redemption for goods. It stresses the value of that transaction as a standalone obligation producing transaction. That is in line with the arguments made by SARS to the SCA, and it's in line with the argument made in SARS's heads. So says SARS, the redemption transaction, or as it's referred to in the SCA judgment, the second contract of sale is a standalone obligation producing contract. We take issue with that respectfully for three reasons. First, we say that it conflates future expenditure and actual expenditure. Section 24C is concerned with future expenditure, and we respectfully refer the court to the tax court's engagement with precisely this question in paragraphs 34 and 35 of the judgment of Nuku J, where the tax court analyzed the significance of the redemption transaction and found that the attempt by the respondent SARS to rely on it confused future expenditure with actual expenditure. The moment of redemption, this is what the tax court found, and we support the reasoning with respect. The moment of redemption is when the previous year's future expenditure becomes this year's actual expenditure. That's the first point we make. The second point we make is that this reliance on the redemption transaction as a standalone obligation producing transaction conflicts with the approach of SARS in Interpretation Note 78 to the issue of gift vouchers. When it comes to the issuing of gift vouchers, SARS accepts that it is the issuing of the voucher, not its redemption, that gives rise to the obligation to incur future expenditure. Even though in the context of gift vouchers...
Mr. Bloomberg, in respect of the gift vouchers, a customer would have paid, there would be someone who would have purchased a gift voucher, and then there would be expectation that that gift voucher would be used at a later stage. Surely there would be, that is the case.
That certainly is, Justice Mhlantla, and we accept that when the customer purchases the gift voucher, that is the income earning transaction. Later on, there's a redemption transaction. The only point that we wish to make is that the existence of a redemption transaction cannot be regarded as an independent standalone transaction for purposes of 24C for the reasons given by the tax court, because the same situation applies in the context of a gift voucher. There is also a redemption transaction. And if I may pause just to focus on the analysis, SARS accepts in the context of gift vouchers that it is the issuing of the gift voucher, not its redemption, that gives rise to the obligation to incur future expenditure. That is why it accepts, as it must, that it is the issuing of the club card rewards, not their redemption, that give rise to the obligation to incur future expenditure. There is a further aspect on this also recognized by the tax court, and that is that one can only make sense of the redemption transaction in light of what went before, in light of the transactions that went before. And for that reason, as the tax court found in paragraph 36, it is artificial to regard the redemption transaction as a completely independent standalone transaction.
Well, Mr. Bloomberg, just back to the last question that my brother Madanga asked. I was concerned going through the papers about this loyalty program. And my concern was heightened by paragraph 29 of the SCA judgment. And let me explain myself. And I'm asking it in the same context as my brother Madlanga asked his last question. This is called a loyalty program, suggesting that it is intended to secure or to retain the loyalty of pre-existing or existing customers of clicks. I'm paraphrasing the meaning. Now, you secure this market, these people are encouraged or incentivized to come to clicks over and over again because there is a benefit or a potential benefit held out to them. Now, this seems to be, as paragraph 29 of the SCA judgment suggests, similar to a discount system that any business might have. Come to buy from us at a lesser price. And people then come in their numbers. As they continue to patronize clicks, what then happens is clicks goes back to SARS and they ask the taxpayer to fund this system or this scheme that is beneficial to me. I'm benefiting because people are coming to me in their numbers, and from the look of things, they are likely to keep on coming and coming. And as the business is strengthened in that way, at the end of a period, clicks goes to the taxpayer and say, reward me for having been as enterprising as I have been to keep customers loyal to me. It's a bit concerning.
Chief Justice, I appreciate the concern that there's a commercial benefit, as there obviously is in the scheme. It's commercially driven, and it's there, as you've pointed out, to motivate sales. The question of the financing of future expenditure and the matching of income to future expenditure, I'm going to touch on that in answer. And I also want to touch on the aspect of discounts and whether that is the nature of the transaction. Perhaps I can start with the second, Chief Justice.
Yes.
2 points to be made on the topic of discounts. The first is the stated case does not characterize the loyalty program as obliging clicks to extend discounts. It characterizes clicks as being obliged to supply the member with goods equal to the value of the reward. It may sound like it's consistent in that paragraphs 19, 21, and 27.3. Now, I appreciate it may sound like a fine distinction. The point is that the exploration of discounts that one see in paragraphs 29 to 31 of Wallace J's judgment is again a line of inquiry directed at testing whether there's any expenditure at all. We've made the point that that point was considered by SARS and abandoned by it. As I say, we've made that point. The second aspect that...
but maybe while you are there, Mr. Bloomberg, just for my own peace of mind, in effect, if you say to your customers being clicks, buy more, don't buy less, because it's only as you buy more that you will accumulate points that will enable you to buy at a discount. And they do. The effect of that seems to be that there is a promise of a discount if you do that. Now, fundamentally, how different is that from a business entity that gives discounts to customers, like the Black Friday that Justice Wallace alluded to, and then turning around, going to SARS and saying, listen, or even to Parliament saying, amend legislation in such a way that every time I give discounts to my customers so that they can come to my business, I've got to be able to claim that back from SARS. fundamentally? What is the difference?
Chief Justice, the key difference, and it's recognized by the applicable international financial accounting standards, to which I'll take the court in a moment if I'm permitted to do so. But the key difference between the two situations is that in the applicant's position, there is a pre-existing contractual obligation to afford the discount. It is not discretionary, and that has very important accounting consequences, and one sees them in the papers. The fact that there is a pre-existing contractual obligation to honor a reward places Clicks in a position where, in terms of the applicable international accounting standards, the rand value of the transaction that equates to the reward, and let's use a practical example to clarify things. Assume that there's a 100 rand qualifying purchase transaction, which generates a 2 rand reward. The accounting standards do not allow Clicks to treat the 2 rand as part of its income for 2009. Clicks may only treat that portion of the income as income when the reward is redeemed. And that's in the papers, I'll come to it in a moment. But the reason for that is that there is a pre-existing contractual obligation to honor that reward. And that is why the international accounting standards don't permit of that value to be treated as income. And Chief Justice, you'll have seen references in the stated case to deferred income. The topic isn't fully analyzed in the stated case, obviously, but one finds an explanation of it in the financial statements of Clicks at volume 2, page 158. Given the centrality with respect, Chief Justice, of your question, perhaps I may be permitted to take the court there.
Yes, Mr. Bloomberg.
So we see, I've taken the court to page 20 of the applicant's 2009 annual financial statements, and one sees under the heading 1 at the top of the page, accounting policies, impact of new international financial reporting standards. In the table, one sees second from the bottom row, a reference to what's called...
Excuse me, Mr. Bloomberg, from what page are you reading now?
My apologies, I'm in volume 2, Justice Cheeky, page 158.
Thank you.
And one sees in the table, the second row from the bottom, a reference to IFRIC 13, which is the accounting standard applicable to customer loyalty arrangements. And one sees in the text that what the accounting standard requires, and I'm going to attempt to paraphrase this, the accounting standard applies to sales transaction in which entities grant their customers award credits that, subject to meeting further qualifying conditions, the customers can redeem in the future for free or discounted goods or services. The interpretation requires that an entity recognizes credits that it rewards as a separately identifiable component of revenue, which would be deferred. The deferred revenue is in fact reflected as a liability on Clicks's balance sheet, and one picks that up a little bit further on at page 166. So the key difference between an ordinary discount and the reward system, the loyalty program, is the existence of a pre-existing obligation that has important accounting implications for Clicks. The implication is this. I referred a moment ago to the rand value of the allowance that is claimed. It's in paragraph 31 of the stated case. That rand value under this accounting standard cannot be reflected as income in the 2009 year. It's reflected instead as a liability for the reasons I've mentioned. There's a pre-existing contractual obligation, and one finds it on page 166. And that, with respect, Chief Justice, is what we submit to be the key point of distinction between an ordinary discretionary Black Friday discount, pensioners discount, and one that has its origin in a preceding contractual obligation.
Yes, you may proceed, Mr.
Mr. Bloomberg, I'll take you back to the Chief Justice's question. You just engaged in a lengthy discourse that's very interesting and may easily confuse and lose one. But once we cut across all that detail, the bottom line, in my view, again, as presently surprised, and I keep an open mind, is that, as the Chief Justice suggests, all that this is a discount. The only difference is that it's a deferred discount. You emphasize deferred revenue. But when we come to this 2 Rand in your 100 Rand example, all that it is a deferred discount. That's the bottom line.
Justice Madlanga, I certainly didn't mean to confuse with my answer. I'd hope to clarify. I think the
I didn't mean it in any derogatory sense, Mr. Bloomberg. Not at all.
I think
perhaps I should not have gone beyond saying, once one cuts across all the detail, all that this is that it is a discount. The only difference between it and other discounts is that it is deferred. You emphasize the obligation, but in a discount that is advertised seriously and intended to be taken up by members of the public, even there, an obligation to honor that discount is created and is a contractual obligation that may be enforced. The only difference is, in your 2 Rand example, it is deferred. You don't get the discount immediately. You get it in future if you meet all the other obligations or contractual obligations under the club card contract.
Justice Madlanga, there's very little that, with respect, we take issue with in what you've put to me. There perhaps 1 or 2 minor points of divergence. We went to some lengths in our heads because this question of expenditure was opened when we submitted shouldn't have been opened, to explain the concept of expenditure in the treatment of stock, and to explain that the net expenditure is incurred on disposal of the stock. That's a fundamental premise underlying the stated case. That is why the stated case refers to the disposal of goods as expenditure and why it doesn't refer to discounts. We accept in what you've put to me with respect, there is a deferral, there is a pre-existing obligation. If the suggestion is that the discount means that there is no expenditure, we're forced to take issue with that because of what's on the stated case.
No, please don't misunderstand me. I'm not for a moment saying that there isn't expenditure. There definitely is. I accept that. But that doesn't address the other issues that one raises, if you see what I mean.
So
Mr. Bloomberg, my difficulty, which I'm hoping that you would assist me with, relates to a point that was raised right at the beginning by my brother Madlanga on the sameness. The question is, does the fact that parties in the club card or the first sale may be different have any bearing at all on the sameness, or it's an irrelevant consideration to consider? I'm saying this in the light of what the SCA held in paragraph 18 of the judgment by Dlodlo, and also paragraph 28 by Wallace, and to also link that with what the CJ took you through on the Black Friday narrative. I have that difficulty, if you can assist me there. Especially the parties, the contracting parties, whether it's irrelevant or not.
Justice Matopo, we submit that it is of central relevance that the parties to the transaction, the two contracts, are precisely the same. And if I may develop that, you have contractual, under the Clicks Club Card program, you have contractual pathways and flows that run in parallel between precisely the same parties. And what I mean by that is that if one considers Clicks on the one hand and a loyalty program member on the other, you have income flowing from the member to Clicks, and you have future expenditure in the form of merchandise flowing from Clicks to the member. The parties to the transaction are the same, but not only that, the contractual flows, if I may call them that, are moving between the same parties. And that, we submit, presents two important points of distinction. The one is with the facts before this court in Big G, where the income in question flowed from restaurant patrons to the taxpayer, but there was no parallel return obligation. The contractual pathways diverged in that the taxpayer owed the future expenditure obligation to the franchisor. That divergence of contractual flows and pathways we find in the case of affinity partners too, in the loyalty program context. And that is precisely why affinity partners are out of the reckoning for the 24C allowance. So in the case of affinity partners, you have the income flowing from the club card member to the affinity partner store, but you have the future expenditure flowing from Clicks to the member. And again, diverging contractual pathways and flows when it comes to the transactions, the specific transactions that are claimed under the allowance, one has parallel contractual lines between the same parties.
Mr. Bloomberg, please help me to when it comes to numbers and tax, I've got a bit of a challenge. That's why whenever SAR says pay, even if I think I owe them nothing, I just pay. But help me to understand this. Is the amount claimable by Clicks the total amount of discount that would have been given to customers, or is it lesser?
What Clicks is...
Just simplify it for me.
Yes. During 2009, Clicks issued rewards, and certain of those rewards remained unredeemed at the end of the year.
Oh, no, I'm sorry, Mr. Bloom. Let me just simplify my question. As a matter of principle, when Clicks gives all the members in a particular financial year a discount of 10 Rand, all of them put together, is it 10 Rand that Clicks is then entitled to claim from a SARS or a lesser amount?
It's a lesser amount.
50% of that?
It's 75% of that in round terms. The parties, Chief Justice, have agreed that, and what it comes down to is this, with respect to your 10 Rand example, is that the 10 Rand is the shelf price of the goods to which the member is entitled. That's not what is claimed. What is claimed is the cost to Clicks of that shelf price of 10 Rand. And so what the parties have done is they take the 10 Rand and they remove an agreed profit margin, which they've agreed between them and which features in the stated case.
Okay. Now, you see, this is where I'm getting to. I'm really trying to go to the matter of the issue. Clicks benefits from, or let me put it this way. Clicks effectively gives a discount to customers, and then it claims the equivalent of what customers went away with. Now, who bears the responsibility for that money that the customers benefited? Tell me if my question is not clear. You see, the gap that was created by the discount is then filled by SARS paying back to clicks the cost of the stock, if I understood you correctly. Now that amount, that representing the discount, who bears the responsibility for it? Because clicks at the end of the day got back what it would otherwise have lost. Who pays for that money? Who pays that money now that the customers went away with? In other words, who pays back to clicks what it would otherwise have lost? Where does that come from? What is the source?
When clicks completed its tax return for this year, and I'll come to the 10 Rand example. It's a handy one. It declares its taxable income in the ordinary way. It treated the cost to clicks to itself of honoring those rewards as 10 Rand, and if we may call it in round terms 7.50 Rand. It treated that as an allowance in terms of Section 24C. That comes off, that is treated as an allowance in the 2009 year, and it is added back to clicks' taxable income the following year. That is the consequence of Section 24C3. And the reason it's added back in the following year goes to the purpose behind the section, which is to match the receipt of the income and its taxation with when the expenditure is incurred. And coming back to the 10 Rand voucher example, we know, and it's accepted, this is not in dispute, that the expenditure is incurred the following year when the customer hands over the 10 Rand voucher and receives goods with a shelf price of 10 Rand. That is when the expenditure is incurred. That's not contentious with respect. What Clicks has done in line with the section is to defer or to claim an allowance in respect of the cost of honoring that reward, to claim the allowance in the 2009 year and pay the tax on that amount in the 2010 year when the expenditure is incurred. I hope, Chief Justice, that answers the question.
No, you have answered my question, but let me just tell you without seeking an answer where I was coming from. This is where I was coming from. I was saying, we need money here. We are a troubled country. And any tax benefit that anybody receives must be seen as beneficial, either generally to the economy. For you to be able to deduct back what you should have paid to our coffers so that we can do whatever we need to do with that money. You really have to show us who benefits from this. If it doesn't look like it's beneficial to the economy, then maybe we must think it again. But I don't understand the numbers in the economy. So that's why I was trying to understand, but what's going on here? Why should Clicks be getting back any amount in the first place? And did it get prejudiced in any way, or is it being paid back or allowed to benefit from benefiting itself through a strong customer base or a loyal customer base? That was just what I was trying to understand.
Chief Justice, one appreciates, of course, those broader concerns, and it is it's a balancing exercise that the drafters of the legislation have to get right between maximizing revenue while at the same time being fair to the taxpayer. 24C goes some of the way to creating that fairness. If income is used to finance revenue in a future year, the income is taxed in the future year. And that is with respect what Click seeks to do.
Yes. Now, thank you, Mr. Bloomberg.
Mr. Bloomberg.
Mr. Bloomberg, can I just ask you on jurisdiction and the leave to appeal? I'm just concerned about that. Big G has settled the law concerning the interpretation and the application of Section 24C. And my concern is whether this court now will be expected to adjudicate all these other cases that arise from Section 24C, because the earlier debate you've had with my colleagues has also shown that different entities, different retail shops or stores have different loyal programs. And my concern arises from that, because if this court has settled the law regarding Section 24C, how it should be interpreted and applied, why should we then entertain this case and any other case that revolves around Section 24C?
Justice Cheeky, that is a question that we must address square on. We accept that it's at the heart of today's proceedings. We point out, first of all, that in Big G, the court found that its jurisdiction was engaged not on the basis of the exercise of statutory interpretation that the matter raised, but on the basis of the matter of contractual interpretation. And we see this from paragraphs 11 and 16 of the judgment. It was the question of contractual interpretation in Big G that triggered the court's jurisdiction. The second point is that, Justice Cheeky, as you've pointed out, and this appears from the court's judgment in Tiki Dry v. Shell too, matters of contractual interpretation, while they are no doubt questions of law, they are generally going to be matters of limited implication. They will only impact upon the parties to the contract. And for that reason, matters of contractual interpretation generally won't engage the court's jurisdiction because they will not be matters of general public importance. We accept that. Tiki Dry went further with respect and said that where a matter of contractual interpretation has broader implications, for instance, because the type of contract in question is in widespread use, this would engage the court's jurisdiction. When it comes to the widespread use, if I may speak off the papers for a moment, to appreciate the prevalence of this type of loyalty program, one only needs to do something as rudimentary as an online Google search to be directed to the 25 most successful loyalty programs in the country. They're prevalent. They operate on the same substantial basis. They are based on membership. They are based on the earning of rewards, and they are based on the redemption of the rewards. So our submission is that the answer to the question that we formulated has relevance to all operators of reward programs whose members are issued redeemable rewards. This contractual question has a broad net of implication. We add to that, and it's a related point, Justice Cheeky, that the matter is of importance to SARS too. SARS is not an ordinary litigant. We know it's the branch of government that's responsible for administering tax legislation and collecting tax. SARS said itself to the SCA through its counsel that the matter would be an important precedent for SARS. There's a reason for that, and that's taken from SARS's own mouth in its answering papers. It would be an important precedent. We know, however, with respect that the SCA judgment is not good authority on the question because it applied the incorrect interpretation. Justice Cheeky, there's one more point in response to your question, and it's this. The point about the question of interpretation being settled, we find the answer to that in the heads of argument of SARS itself in paragraph 42, where SARS acknowledges, as it must, that this court endorsed a wider test in Big G than had the SCA before it. SARS goes on to say this court recognized the principle of sameness between the contracts, but the degree of sameness required was not defined by this court. That is out of the mouth of SARS, and we endorse that completely. We know how the test has been formulated with respect, but we don't know what it means. We don't know exactly what degree of sameness is required to constitute two contracts as being inextricably linked. It's a topic we also take up in paragraph 99 of our own heads.
A small correction, Mr. Bloomberg. My sister Justice Chikri said that what was at issue with regard to jurisdiction was the interpretation of Section 24C. And you say, no, that's not the case. It was the interpretation of the franchise agreements. Here's the correction. Towards the end of paragraph 11, the judgment says, this interpretative question is a quintessential point of law. That, of course, is indeed, as you said, a reference to the franchise agreements. But then the judgment continues. This question is also closely bound up with the interpretation of Section 24C2. What is the nature of the contract envisaged in the section? This element of interpretation adds to the legal character of the question to be determined. So I'm just making the short point that you should not have been dismissive of the point made by my sister Justice Chikri.
No, I'm grateful, Justice Madlanga, and I certainly didn't mean to be dismissive. On the contrary, we accept that this is very much at the heart of what we must address. But the submission that we make on the nature of the question is this. The character of the question today before this court has the same character of the question that presented in Big G. It is a mixed question of contractual interpretation and statutory interpretation, and that's what makes it, with respect, a question of law. That's the high water mark of our submission on the nature of the question. We accept unreservedly that there was at least a statutory interpretation component in Big G, but the court was pertinently pointed out in paragraph 16 that it wasn't only about statutory interpretation, it was about the interrelation of the two contracts with the section. And with respect, we're into the same terrain in this case.
Mr. Bloomberg. Before I ask my question, I'd like to take you back to the question that my sister Justice Mtlantla posed to you. It was in relation to paragraph 17 of the SCA judgment, which stresses the value of redemption transaction as a standalone transaction. In response, Mr. Bloomberg, you said that you take issue with that on 3 grounds. You had told us the 2. The first one is that it conflates future expenditure with actual expenditure, and that the second one relates to the interpretation note 78, and you gave the example of gift vouchers. You did not yet have an opportunity to give us your third ground of difference, or the ground upon which you take issue with that.
Yes, thank you, Justice Duron. The third ground, and yes, is that where we again have the benefit of the reasoning of the tax court. The tax court found that it was artificial in paragraph 36 of Nuku J's judgment to regard the redemption transaction as a standalone contract. One can only make commercial sense of the redemption transaction in light of the preceding transactions. To put this bluntly, the redemption transaction, if one ignores what went before, it's a commercial nonsense with respect, because the member hands over a piece of paper and receives merchandise in return for it. The piece of paper is not cash, it's not a credit card, it's not legal tender. One can only make sense of that transaction in light of the fact that there are obligations on clicks to issue rewards and redeem them, 1, and on the fact that there has been a reward generating purchase transaction. And those are the reasons why we say the tax court was correct with respect in finding that treating that redemption transaction as a standalone one was artificial. And again, I don't want to belabor the point, but the same principles apply to a gift voucher. In the context of a gift voucher, one cannot disentangle the redemption transaction from the preceding sale of the voucher and treat them as separate standalone transactions for purposes of the section, and SARS doesn't do that.
Mr. Bloomberg, in response to the question from my sister Justice Chikli on jurisdiction, part of your answer was that SARS acknowledges that this court endorsed a wider principle in Big G than the SCA did. You then went on to say that the degree of sameness has not been identified in this court. If I understand your heads of argument and the submissions that you've made, the arguable point of law that the applicant is raising in this matter relates to whether contracts can be said to be similar or the same or inextricably linked, where one contract is dormant without the operation of the other. Is that correct? For the purposes of claiming income and future expenditure under Section 24C.
Yes, I think that's fair enough with respect, Justice Dron.
Now, you also mentioned Tiki Dry in your response, and you further mentioned that it would now be necessary to place the meat on the bones to that test. I understand that this is not really the fault of the applicant, but this question is being raised for the first time in this court. This court does not, that question that the applicant is raising of when contracts can be said to comply with the degree of sameness required in 24C. This court on that aspect would be sitting as a court of first instance, in that it was not also raised in the SCA. And would it be advisable for this court to deal with that question when it has not been raised before and this court doesn't have the benefit of, in particular, a judgment from the SCA on this?
Justice Dron, I appreciate the import of the question. I can point out that the argument about the interrelationship between the loyalty program agreement and the reward generating transaction is not a new argument that follows upon this court's judgment in Big G. That argument formed part of CLICS's appeal document against the disallowance of the objection. It formed part of the pleadings before the tax court. It was argued before the tax court. The tax court, in finding that the purchase transaction, the individual purchase transaction was obligation producing, did not disregard the operation of the loyalty program agreement. The tax court recognized the combined operation of the two agreements. What followed then was something of a sea change. After the tax court's judgment, and in December of 2018, the Supreme Court of Appeal adopted its same contract finding in Big G, whereby the requirements of the section could not be met by two or more inextricably linked contracts. So we appreciate that in principle, the SCA did not entertain the argument we now advance on its merits exactly because of the approach it took, but there are at least shades of engagement with the question, in fact, more than shades, we'd put it, in the tax court judgment, and it has been the argument all along with respect. And in relation to our submissions on leave to appeal the interests of justice, we submit that there's an unfairness in CLICS's position if, having contended throughout that the transactions are inextricably linked, and I've traced the documents, its case were finally decided on a basis that we all know to be incorrect.
Would that unfairness or the unfair position that Clicks finds itself in not perhaps be ameliorated if this court was to remit the matter to the tax court in light of the Big G judgment and the wider test emerging from that judgment, so that the question of sameness can be fully ventilated?
Justice Theron, the unfairness would be, it would be alleviated, yes. If what Click seeks with respect is the opportunity is no more than what the taxpayer in Big G had, the taxpayer which came to this court before Clicks, which is the opportunity to have its claimed allowance decided on the basis of the correct law. That is what Click seeks. And if that can be achieved through remittal of the matter, that would alleviate the injustice, yes, with respect.
Thank you, Mr. Blumberg.
Mr. Bloomberg, at paragraph 99.1 of your written submission, you argue that this case should be given leave to appeal on the basis that it seeks to develop the law by developing the meaning of inextricable link. You rely on the case of K versus Minister of Safety and Security. I'm not sure of where you seek to go with this reliance. Can you please just make a submission in that regard?
Yes, Justice Kampepe, the reliance is one by way of analogy. The case of K had to do with the common law test of vicarious liability and the articulation by O'Regan J as to whether a new set of facts fell inside or outside the existing test and the extension of common law rules in that context. We accept that this is not the same principle. We argue by analogy. We say that there was an application of the inextricable link test in BG, or rather Big G, to a particular contractual structure. Here there will be the application of that test to a different contractual structure. In so applying the test, the court will put meat on its bones.
Can I just ask you a question for clarification on the degree of sameness? Because you said that what needs to be clarified by this court is the degree of sameness. So you accept that the court has said that has already pronounced itself on the principle of sameness, but you then said that what Clicks seeks this court to clarify is the degree of sameness. And as I'm sitting here, I'm wondering whether that is a legal principle or a factual inquiry, and whether a degree of sameness will be the same in all loyalty programs and so on.
Justice Cheeky, if I may point out, first of all, there's a measure of tension in the debate, and it illustrates the openness of the law on this topic. The proposition from Justice, or the concern from Justice Theron, was that this matter raises a question of law which has never been considered before. The concern raised by yourself, Justice Cheeky, is that the matter has already been pronounced upon. We say that this highlights the uncertainty in the position, first of all. But second, coming to the question of whether it's a factual or legal exercise, at the heart of the exercise is the interpretation. There are two exercises. The one is interpreting the two contracts, the loyalty program agreement and the reward generating purchase transaction, with a view to deciding which of those is obligation imposing for purposes of Section 24C. We've made the submission that that question is has the same character as the question that faced this court in Big G, in that it's a combined question of contractual interpretation and statutory interpretation. There's no, and if I can be direct about it, there's no witness that can give an answer to the question that faces this court. It's a legal question with respect.
What is the legal question to which no witness can testify? Is the degree of witness of sameness.
So there are two legal questions that no witness can testify to, and that are legal questions. The first is whether the obligation to incur future expenditure is produced by the loyalty program or the qualifying purchase, or a combination of the two. That's question number one. And that's contractual interpretation. And question number two is, depending on the answer to that question, are the requirements, or does that contractual structure meet the requirements of section 24C2? That is an interpretive question, and also with respect one of law. And
are you then submitting that Big G did not give guidance on how to answer those questions?
We Justice Cheeky, we accept wholeheartedly that that Big G gave guidance on the question of statutory interpretation. The threshold to a section 24C claim has, to an extent or in one respect, been lowered, in that we know now that the requirement of sameness can be met by two or more contracts that are inextricably linked. What we say, and we understand SARS to say the same, is that we do not know exactly when two or more contracts are inextricably linked. There remains an exercise of putting flesh on the bones of that test and of demarcating the degree of sameness.
Mr. Bloomberg, pardon me if my approach is on a narrow point, as the SCA found. In paragraph 29 of your heads, if I read them correctly, you seem to concede that, if I were to read it out aloud to you, this court in BG confirmed that the interpretation of a contract to determine whether they comply with section 24C is a quintessential point of law that engages this court's jurisdiction. I'm following from what my sister Chiti put to you, that if indeed this court has already pronounced itself on that, is the issue not settled? What you are raising about the investigation, the investigation or the interrogation as to whether it's the sameness or not, is that not a question of fact?
Justice Matopo, I don't think that I can do better with respect than refer again to the question is, I think, answered in paragraph 11 of this court's judgment in Big G. And on this point, whether it was a question of fact or question of law, the majority and the minority diverged. But the finding in paragraph 11, in particular the first part of that paragraph, relates to the interpretation of contracts. And in that case, the contracts were, in Big G, the franchise agreement we know, and the contract with the individual restaurant patron. The court held in paragraph 11 that interpreting the two contracts was a question of law. We say the same applies here. We go further than that to say that the additional quality of legal character added in the second part of paragraph 11, that the contractual interpretation flows into one of statute, it adds to the legal character. We say that the same applies here with respect. But the starting point is that when one is interpreting contracts within 24C, that is a question of law. That this court held. The minority, of course, disagreed. There is, with respect, no remaining quibble about whether the exercise in contractual interpretation is one of law or not. There are, of course, remaining questions about whether contractual interpretation in itself will engage the court's jurisdiction.
The problem that I have, I hear what you're saying, and I call to mind what my brother Madlanga put to you when you sought earlier to rely on the contractual interpretation as a question of law. And he invited you to the remaining parts of paragraph 11, where it talks about the statutory interpretation. What I want to ascertain from you is, considering the ratio in paragraph 11 of the judgment, is the issue still not settled or not?
Justice Matopo, I appreciate the import of the question. The ratio in paragraph 11 must be read with respect together with paragraph 16 of the judgment. And what one finds from paragraph 16 of the court's judgment in Big G is that the question that predominantly engaged the court's jurisdiction was not the question of statutory interpretation. We accept and we embrace that one cannot surgically separate the two questions. They must run together for purposes of 24C. But if one reads paragraphs 11 and 16 together, we submit that what weighed with the court predominantly in granting leave and finding that there was a question of law was less the question of statutory interpretation and more that of contract. And one finds it in paragraph 16 because one finds a concern of the court being expressed that every time there's an interpretative dispute about a section of the Income Tax Act, it's going to end up in front of this court. And the court was cautious to see to it with respect that that did not result. And for that reason, there was emphasis on the exercise in contractual interpretation, which in that case was held to be one of wide import, given the prevalence of franchise agreements of Spur restaurants.
You know, when I read paragraph 16, the court seemed to be cautioning against opening the floodgates. And if this appeal, I know the respondents have taken issue the fact that it does not engage our jurisdiction. If they are right, the argument would be on the line suggested or proposed by my sister Chitli, that what are we now doing when we have already decided on this issue? Is this not what Madlanga J cautioned us in paragraph 16, that this is not an open sesame thing? In other words, all what he was saying, if I were to interpret it, each case must be looked on its own facts. So in this case, when you stripped it of its bare essentials, all what this case is about, it's the sameness. And it's a point that has already been definitively decided by Big G. So we would basically be revisiting it and say this court has already pronounced itself in BG that this is what is it. Don't you think this is a burden on the courts, or there is another angle? I know you did raise an issue that the SCA seemed to have applied a narrow view or a narrow approach, and your colleague, the respondent, seemed to agree with you that they should have applied a wider approach. And I'm not too sure if that on its own would constitute a ground to engage this court's jurisdiction.
Justice Matopo, to come to the question of sameness and whether there's a potential for a deluge of litigants, there are 2 points that we must make in response. The one is the answer to that we suggest is contained in paragraphs 13 and 14 of this court's judgment in Tiki Dry. I've referred to them. Contractual interpretation is a question of law, but generally not one that engages the court's jurisdiction unless it's a contract in widespread use. We have to satisfy the second requirement of widespread use as per the court's jurisprudence in Paulson v. Slipknot to engage the court's jurisdiction. We accept that wholeheartedly. But the question that we must be firm on.
Mr. Bloomberg, please could you repeat your submission? We lost you for a minute or so when you were referring to paragraphs 13 and 14 of Tiki Dry.
Yes, my apologies, Justice Duran. The submission that I was making, and as I make them, I'm going to, if I may, pull out Tiki Dry just to make sure that I'm absolutely, yes, it is paragraphs 13 and 14. A question of interpretation of contractual interpretation is a question of law. First, we say. And I'm going to I'll return to that in a moment. Second, we say that as the court recognized in Tiki Dry, the mere fact that it's a question of law is going to be insufficient in almost all but the rarest of cases to engage this court's jurisdiction, its general jurisdiction, because a question of the resolution of a contractual interpretative dispute only bears on the party to the contract. In this court's judgment in Tiki Dry, the court recognized that where the contract is one of widespread use, then the considerations are different. Then one has a question of law, and one has a question of law of general public importance. We make the submission that there is a question of law that is of general public importance, and one can make it on a narrow level and a broad level. The broad level is, does Section 24C apply to loyalty programs? That's the question that remains unresolved at this stage. The more specific question is the one that we formulated earlier. But I said I would come back to the point of contractual interpretation being a question of law. And I come back to it because of what we're debating and also because of the content of SARS's heads. We find the submission in SARS's heads, and it's in paragraph 58.5, that contractual interpretation should no longer be regarded as a question of law, it should be regarded as a question of fact. The logical basis, as SARS has it, of that proposition is that the principle that contractual interpretation is a question of law, not fact, cannot, according to SARS, coexist alongside the principle that contextual evidence is admissible for purposes of interpretation. The submission advanced to the court by SARS is that those principles are in conflict, and because of that, the court should find that contractual interpretation is a question of fact, not law. SARS cites the 2014 SCA decision in Botma Batu as authority for the proposition in 58.6 of its heads. We say with respect that case is authority for the opposite proposition. if I may submit very briefly why that is. If one looks at paragraph 11 of the SCA's judgment in Botmapatu, one sees that the approach of the SCA in that case followed the approach in its earlier 2012 decision in KPMG v. Securefin, the well-known judgment of Harms JA, and more particularly paragraph 39 of KPMG v. Securefin. Now, paragraph 39 of Harms JA's judgment recognizes very lucidly with respect that the principle that in contractual interpretation is a question of law on the one hand, and the question that evidence may be admitted to contextualize a contract on the other are not conflicting principles. They exist and they're applied side by side, and they have been for many years. Paragraph 39 of Harms JA's judgment in KPMG v. Securefin has a very long and unblemished pedigree. Justice Saran, I can see that you're shaking your head. Am I not coming through, if I may respectfully ask?
You broke up, but just very slightly. My concern is with Justice Matupo. Thank you, Mr. Blumke.
May I proceed?
Yes, you may proceed, Mr. Blumke.
That paragraph of Harms JA's judgment I was indicating has a very long and unblemished pedigree. It's been cited by this court on a number of occasions, and most recently, recently at the end of 2018, by the SCA in its judgment in City of Tshwane v. Blair Athol, the judgment of NAVSA JA. In that judgment, NAVSA JA confirmed very emphatically that the law remains as it was in paragraph 39 of KPMG v. Securefin. Interpretation is a question of law. NAVSA JA clarified that Endumeni did not change that, Endumeni reaffirmed that. So that is the position, and that is why, with respect, we find these statements in paragraphs 11 and 16 of this court's judgment, the majority judgment in Big G, that contractual interpretation is a question of law. There can, with respect, be no quibble about that.
Are you done, Mr. Bloomberg?
Yes, Chief Justice, perhaps two topics briefly. Well, the affinity partners was one of them. I think I've covered that. I've indicated the divergence of the contractual paths. The final point, if I'm permitted to, is to say something about the Big G decision on the merits, and to compare the position of the two taxpayers, the present applicant and that in Big G. We accept that there was a similarity in the case in that they both concerned the interrelationship of two contracts for purposes of Section 24C, but we submit that there were clear differences between the two. First, as I've mentioned, in Clix's case, the parties to the two contracts are the same and the contractual flows move in the same direction. Second, we say that in Big G, the contractual obligation that the taxpayer owed to the franchisor to incur expenditure in respect of refurbishment existed entirely independently of the income received by the taxpayer from restaurant patrons. Those were not linked. In the applicant's case, the income and future expenditure are, we submit, conjoined. It's the very receipt of the income that gives rise to the obligation to incur future expenditure. And third and finally, it weighed heavily with the court in Big G that the category of expenditure in respect of the allowance, in respect of which the allowance was claimed, being the refurbishment of the premises, would have arisen even in the absence of a franchise agreement that specifically required it. Because even an unattached restaurateur has obligations in relation to the upkeep of his restaurant. But in the present case, the type of expenditure we're talking about, providing free or discounted merchandise, would not exist at all were it not for the combined operation of the loyalty program agreement and the qualifying purchase transaction. We submit that there are clear and important points of distinction on the merits of the two cases.
Chief Justice, with your leave, there are two aspects I would like to explore with Mr. Bloomberg.
But this one is picked up, so you can use this one.
Mr. Bloomberg, the first question relates to the income that is received and the purpose for which that income is used. And if we look at paragraph 26 of Justice Wallace's judgment in the SCA, the first sentence says, the reason section 24C was introduced was not to afford a means whereby the taxpayer could take account of expenses foreseen but not yet incurred, but to alleviate the tax burden that would otherwise rest on builders and other taxpayers engaged in the manufacturing business. The income that Clicks is receiving, and we're talking only now about transactions in relation to the loyalty program. Clicks is not using that income to perform any obligations, such as a manufacturer or a builder would have done. The position of the builder is that the business of the builder, the SARS has created a dispensation where the builder is given some leeway so as to continue functioning properly in that business. And if that leeway is not given to the builder or a manufacturer, the business might collapse. Do you see a difference between that scenario and the scenario that we are facing with Clicks?
Justice Rod, we see both differences and similarities with respect. We don't seek to shoehorn the case of the applicant into the builder scenario. We accept that there are differences, but with respect, the applicant doesn't have to be shoehorned into that category. SARS recognizes in Interpretation Note 78, as it must, that the application of Section 24C is broader than builders and manufacturers. SARS says so in express terms in its interpretation note. That recognition is in line with the tax court authority that SARS cites in its interpretation note. So that's the first point we make, is that everybody accepts that the text of the section is broader than of exclusive application to the builder's scenario. One doesn't see the phrase advance income or a deposit featuring in the text of Section 24C. It's absent from the section. The second point, the similarity. When the builder receives the deposit, the builder knows that at a later point, either that year or the following year, the deposit will be expended. It knows that. I forgot for a moment while I was making this point. I remember now. It was in relation to Justice, to Wallace J's reference to unforeseen expenditure, that the purpose of the section is not to cater for unforeseen expenditure. The expenditure is not unforeseen in the context of the builder because the builder knows he or she must expend it. The expenditure is not unforeseen in Clix's case because Clix knows that for every rand of income it receives from a loyalty program member, it must return 2% of the value thereof. It is not unforeseen. It's known and quantified at the till point when a purchase transaction is concluded.
My last question, Mr. Bloomberg, would relate, what would your submission about costs be if this court was to remit the matter to the tax court?
Justice Teron, if I may ask an indulgence, may I be permitted an opportunity to consider that question? And perhaps I can, if I may, deal with it in reply. As I sit here, I'm not sure what the answer is.
Yes, you may. And that would relate to, yes, you may. That would relate to all the costs incurred thus far, Mr. Bloomberg, in the tax court and in the SCA, and then in this court as well. Thank you, Chief Justice.
Thank you.
May I just ask one last question, please?
Yes, please. Yes, please.
Thank you. Mr. Bloomberg, to take you back to Justice Wallace's paragraph 26, and the last part thereof, is Clix in fact paying, is Clix in fact diverting the payment of tax by not paying it in the year when the transaction took place, when the purchase sale took place?
If it were, Justice Victor, the way to answer the question, if I may suggest, is to come back to the example, the concrete example we were using of the 100 Rand purchase that generates a 10 Rand reward. The cost of honoring the reward we know is 7.50 Rand to Clix. If Clix, we know that 7.50 Rand of that transaction has to be applied towards the cost of honoring the reward in a future year. If it is not for the allowance, Clix is taxed on the amount of 7.50 Rand, and it only has 5 odd Rand then, once tax has been paid on it, to put towards the cost of honoring the reward. The purpose of the section is to leave the 7.50 Rand untaxed so that it can be applied to the cost of honoring the reward.
And if the reward is not taken up in the same year, how is that concretized? Where if you compare that with a building situation, a construction situation, one knows that particular subcontractors have to be paid in year 2, but the money is received in year 1. How is that analogous in the Clix situation when the purchase is made in year 1 and the benefit is claimed in the same year? It just seems to be a very complicated accounting exercise.
Clix obviously has the accounting standards require a level of record keeping by Clix because it cannot account for all of the transaction as income. So it has to know the value of rewards that remain unredeemed at year end. There's no difficulty about that. The parties have agreed quantum. As at the end of 2009, Clix knows 2 things. It knows the value of the rewards that remain unredeemed, and it knows the cost to itself of redeeming those rewards. Make the submission again because it's an important point with respect, Justice Victor, that you raise, that if the allowance is not allowed, Clix is taxed on that amount, and the cash available to honor the rewards in future years, which is a fixed and determined obligation, is no longer there, or it's substantially undermined.
Thank you.
Thank you, Mr. Bloomberg.
Thank you, Chief Justice.
Mr. Ellis?
Thank you, Chief Justice. I am not going to follow the heads as they are before you. I am going to make 2 points regarding the question of leave to appeal, and then I'm going to deal with the merits of the matter. The first issue, as far as the leave to appeal is concerned, I want to make the point that it is indeed a matter of the interpretation of the contracts involved in relation to Section 24C that is to be decided. In my submission, the interpretation of Section 24C has been settled in Big G. There is no reason for this court to deal with that matter again. What remains is the issue of the interpretation of the CLICS contracts and their relationship to Section 24C. Now, as my learned friend correctly pointed out, the mere fact that there is an issue about interpretation of contract before the law does not necessarily engage this court's jurisdiction. He referred the court to the consideration that may be different if there are types of contracts that are in general use, and that the judgment may have an impact on the interpretation of those. But my submission is that that submission misses the point. It misses the point in the sense that it is not the interpretation of these contracts alone or similar contracts alone that are before this court. What is before this court is the tax treatment of those contracts. And my learned friend took great pains to formulate his heads on the basis that that is the issue that engages this court's jurisdiction. And he did so by referring inter alia to two international cases, the Baxi case and the AMIA case. And I will get to those cases shortly. And he says in his heads that the tax treatment of loyalty schemes should be considered by the highest courts in the land because it has been done like that in other jurisdictions. Now, my submission is that those cases are to be distinguished from the present case because of for instance, the Baxi case, because that case was decided in the European Court of Justice, which derives its jurisdiction from international instruments. But that is the dissimilarity of those cases. They're not necessarily authority for the point that this court should look at this case. And my submission is that the question that the court should answer in deciding whether or not to assume jurisdiction in this matter is not whether it is a case that is of importance for other other loyalty card holders because of the similarities that there may be with the click system. The question is whether this court should assume jurisdiction to determine the matter again. My submission is that this court has settled the law in big G as far as the interpretation is concerned. The question is now a question of fact, whether the specific contracts that are at stake in the Clicks case satisfies the requirements of sameness as set out in big G. I want to make the further point that in the application for leave to appeal, the applicant does not go so far as to say that other similar institutions running similar loyalty schemes are necessarily interested in the tax benefits created by Section 24C at all. We do not know what their views are. We do not know whether it is something that they even considered or whether it is something that is of any interest to them. The applicant also then refers to the interest of the customers, because it says that thousands of customers have the benefits of this loyalty card system. But it doesn't address the point whether those customers get any benefit from the tax treatment or Section 24C of the Income Tax Act. My submission is that on probability, Clicks would carry on running their loyalty scheme, notwithstanding the fact that they may not be entitled to get the benefits of Section 24C. That is an issue that the applicant nowhere addresses in the application. So it is, with respect, a red herring to suggest that this case is of such importance to other loyalty programs and the general public out there. Chief Justice, I want to then address the question of the so-called no expenditure issue, the judgment of Wallace J.A. And I want to first of all record that SARS stands by what was recorded in its disallowance letter regarding the expenditure, and it stands by paragraph 61 and 62 of the stated case, where the so-called concession is made. But that does not mean that the remarks which Wallace J.A. made regarding the way in which the Clicks Club Cards loyalty program functions are out of place. And I specifically refer to paragraph 29. In 29, Wallace J.A. deals with the similarity of this type of loyalty program, and he makes the point that what is ultimately benefiting the client or the customer of Clicks is that it buys a product at a discount. His Lordship says no expense item is shown in the taxpayer's accounts. It purchases stock. Its purchases of stock are accounted for in the usual way by adding purchases to stock on hand at the beginning of the tax year and deducting the stock on hand at the close of the year. In simplified terms, this is the primary cost of sales. The discount is reflected in the fact that sales are less than they would otherwise be by the amount of the discount. But that is no different from the effects of the pensioner's discount on one day of the week, the stock clearance sale, or the recently popular Black Friday sale. Then in paragraph 30, Wallace J.A. makes the further point. And again, I submit that it is a point well made, where he says in the middle of paragraph 30, in the paradigm case of a building or manufacturing contract, where a deposit is paid at the commencement of the contract, the amount paid to the builder or manufacturer is needed to finance future expenditure in the performance of the contract, such as the purchase of materials needed to perform the contract or the payment of staff. There is, in other words, a direct connection, and I would like to underline these words, direct connection, between the amount received and the performance of the contract, and the latter will require actual expenditure that, but for the need to perform the contract, would not be incurred. So what Wallace J.A. said is that there must be a direct link or a direct connection between the amount received and the performance of the contract. And my submission is that that is completely absent in the present instance. There is no direct link between the receipt of income in the first sale and the expense incurred when Clicks honors the reward program during the second sale.
Mr. Ellis, the 10 minutes has expired.
Thank you, Chief Justice. I just want to conclude this point by reading the last part of this paragraph, where Wallace J.A. said, if when the first sale was made, one were to ask what goods were to be purchased with the price paid by the customer in order to satisfy Clicks' obligations under the loyalty program, the only answer would be that Clicks had no idea and would only know when a later purchase was made and a rewards voucher presented in payment. So my submission is that there is no direct link between these transactions, and such a direct link as was referred to by Wallace J.A. may have created sameness in this contract so as to satisfy the test set in Big G, but it does not.
Mr. Ellis, can I ask you, you referred to tax treatment to be the same between Big G and Clicks, that it should be the same. But let's just analyze it using the 100 Rand example. Clicks would be required to pay tax on the 100 Rand. I say that loosely because obviously the expenses must be deducted.
Yes.
So the liability for the loyalty program of R7.50, that liability arises at the point of sale. Now you say there isn't a direct link, in the Supreme Court of Appeal found no direct link. But if you look at the way the tax treatment, then Big G is distinguishable because it, in a sense, has a tripartite agreement between itself and the franchisor and the customer, whereas in this case there is the direct link between from the moment of the sale to the liability for the loyalty amount. So in other words, Clicks would be paying tax on the 100 Rand and not on 92.50 Rand in year one.
Yes, that is indeed correct. They would be paying.
Is that not then a distinguishing feature from as compared with Big G? So in other words, the tax liability is overstated on that 100 Rand.
No, my submission is not. It's not, because the liability to honor the reward is only given effect to at the time of the second transaction, because prior to the second transaction, Clicks does not know what the client will buy. Clicks does not know whether the client will buy. Clicks does not know whether the client will lose his card. Clicks does not know whether the client will emigrate or decide simply to buy elsewhere. So my submission is that what is the expense that Clicks postulates, it will in fact incur as part of its normal stock in trade purchases for general operations for the next year. There is no obligation on Clicks to sell any particular object to the customer when he walks out of the shop having done the first purchase. That obligation to sell at a discount only manifests itself at the end when the second purchase is made. It is correct that the source of this obligation can be traced back to only the club card agreement. It is not a term of the agreement of sale, the first agreement of sale, but it manifests itself. The obligation to sell at a discount only manifests itself when the second purchase is made.
Mr. Ellis,
Thank you.
I'm sorry. Mr. Ellis.
Yes, Justice.
Help me understand. I understood your argument earlier on to say this court should not consider the issue raised as an arguable point of law because it has been settled in Big G.
Yes.
And later I had the argument about the direct liability link which arises from Justice Wallace's judgment in the SCA.
Yes.
And I would like clarification, is that qualification in line with Big G? Does Big G say there must be a direct liability link for the two contracts to meet the requirements of Section 24C?
Thank you, Justice Jafta. No, the Big G does not use the phraseology of a direct link. It postulates the test of sameness. My argument is simply that the question that needs to be answered in this case of Clicks can be dealt with on the basis of whether or not there is a direct link. If there is a direct link, then the question or the requirement of sameness may have been satisfied, but my submission is that it clearly was not. It is just a different way of expressing the issue of sameness.
Is it a different way of expressing the same issue, or is it a qualification? As I see it seems to me to be a qualification of the principle in Big G. And if that is so, can we say then that the law was settled in Big G in view of what has happened in the present matter from the SCA in formulating the principle that is applicable?
I would submit that this is not a qualification, but just simply a different way of expressing exactly the same thing as the court said in Big G.
All right. My next question relates to the issue of sameness. Does Big G say in every scenario where there's a link or the two contracts are interlinked, then the requirements of section 24C are met? Does it say so, or does it go further than that?
No, my submission is that Big G does not suggest that in all cases where there is a link, the requirement of sameness is satisfied. It says that it must be the same contract. The same contract need not be in the same document, but it must satisfy the requirement of sameness. It does not go so far with respect as to say that any number of contracts that are somehow linked may satisfy that requirement.
Is it clear from the judgment in Big G under what circumstances two contracts may constitute or may meet the requirement of sameness?
I can do no better, Justice Chapter, than to read from paragraph 18 of Big G, where Justice Madlanga says, on my interpretation, it is a requirement of the section that the contract in terms of which the income that is to finance the future expenditure is received or accrues must be the same contract, and same is emphasized, under which the expenditure is incurred. So there is a requirement of sameness, but I do not read the sameness requirement to connote that there must, for example, in the case of a written contract, be one piece of paper stipulating for the earning of income and the imposition of future expenditure. Two or more contracts may be so inextricably linked that they may satisfy this requirement. Of course, this principle was stated, and it is left to litigants to decide whether or not that principle applies to their case on the facts. My submission is that in the facts of this case, it does not.
No, as I understand the applicant's case, and correct me if I'm wrong, it is that, yes, we accept that in Big G, the court said two contracts which are inextricably linked can meet the requirement of sameness.
Yes.
That's a general principle. But the court did not go further and say, these are the circumstances under which two contracts which are interlinked may meet the requirement of sameness. And they are saying, we want this court to develop the principle and state clearly under which circumstances may two contracts which are interlinked meet the requirement of sameness. So isn't that a development of the principle? My point being that, can we say in these circumstances that Big G has settled the law insofar as the principle of sameness applying to a situation where there are two contracts?
My submission is that the principle was stated in Big G. The applicant now asks this court to apply that principle to the facts of their case. So my submission is that it is not asking this court to develop the principle further. The principle is there.
What is the principle regarding sameness? where there are two interlinked contracts? What is it that a party must prove, must establish in order to meet sameness where it relies on the existence of two interlinked contracts?
Justice Jafta, I can again only refer to what was said in Big G, namely that the terms, the contract in terms of of which the income is to finance the future expenditure received or accrues must be the same contract under which the expenditure is incurred. So the contract or two or more contracts that come together must contain both the receipt of income and the obligation to incur the expenditure. So on that basis, my submission is that it is merely an application of the principle already laid down that the applicant seeks to rely on.
Are you suggesting that both requirements of income generation and the obligation for future expenditure must arise in each of the two contracts, or can one arise in one and the other on the second contract?
Justice Jafta, my submission is that applying the test, it must be a situation where the one cannot exist without the other. In the present instance, the source of the obligation to pass a credit is not the first sale. The first sale is a transaction that stands on its own feet because the customer walks into the shop, takes the merchandise from the shelf and pays the purchase price like any other person. Then something happens at the till where points are logged, which happens not because of the fact or in terms of the sale contract, but in terms of the contract, the loyalty program contract that preceded it. So in my submission is that these two contracts are not dependent on one another. So is the third transaction, which is the actual sale where the points are being redeemed. That is again a contract of sale on its own. The only difference there is that when the customer comes to the till and hands in his voucher, the price is reduced in terms not only of the contract, or not of the contract of sale, but in terms of the loyalty program contract.
And that clarification is in Big G. The clarification that you have just made, that the contracts, one must depend on the other. That clarification is in Big G.
Justice Jafta, not in so many words.
Okay.
But my submission is that it is clear from the application of the principle in paragraph 18.
Okay. Thank you, Mr. Ellis.
Mr. Ellis, I would like to pursue that line of Justice Jafta with you a little further, please. I would like you to have regard to paragraph 99 of the applicant's heads of argument, as well as paragraph 42 of your heads of argument. In response to one of the questions of my brother Justice Jafter, you submitted that the test from Big G would have to be applied.
Yes.
As I understand Big G, and you may correct me if I'm wrong, Mr. Ellis, Big G introduced or recognized the principle of sameness between the contracts. Big G did not set a test to determine that sameness. And when I read your heads of argument at paragraph 42, it seems to me that that is also your understanding of what this court did in Big G. It is stated in paragraph 42 that Big G endorsed a slightly wider test than the SCA in that it recognized the principle of sameness. And you go on to state, and this is important in our current discussion, the degree of sameness required was not defined therein. And this is what the applicants say at paragraph 99 of the heads of argument. The question before this court is to develop that principle in terms of setting the standards or the test and how it is to be applied. In paragraph 99, subparagraph 99.2, they make the point of the two particular questions that must be clarified.
Yes. Justice Tron, we stand by paragraph 42 of our heads. It is correct that the degree of sameness was not expressly defined in Big G. That is indeed correct. It is correct that what the applicant asks this court to do is to develop that principle further and to find that their contracts fall within the test set out in Big G. And yes, that is as far as I can take this point.
Thank you, Mr. Ellis.
If I may then refer to or come back to the point of a direct link. My learned friends in their heads of argument quoted two international cases. The one is the case of AMIA, and the other one is the case of Baxi. Now, or LMUK as it was referred to. What I want to draw to the court's attention was the judgment of the UK Supreme Court in the AMIA matter. Now, just as a brief interlude to this submission is that what was before the Supreme Court was not a similar scheme of loyalty program and tax treatment thereof, but it dealt with a scheme where a loyalty program was conducted by an outside company called LMUK, and there were actually 4 actors in this scheme. One were what is referred to as the sponsors and the others as the redeemers. The sponsors being the persons at whose shops loyalty points are being generated, and the redeemers other shops where the points are being redeemed. And then the fourth actor in this scenario was, of course, the customer. And the court makes the valid point with respect in that case, after having described these arrangements. In paragraph 7 of the AMIA judgment, it says, as is apparent from this summary of the arrangements, which reflects the findings of fact made by the Value-Added Tax and Duties Tribunal, bearing in mind that this particular case was about value-added tax and not income tax. To refer to points in inverted commas being issued in inverted commas, purchased and redeemed is to speak metaphorically. The points are a means of describing the collectors, now the collectors are the customers, contractual rights to receive goods and services at no cost or at a reduced cost. So it really, to a large extent, debunks this myth of handing back something to the customer or giving something to the customer. What Clicks does is, through its loyalty program, entices customers to buy more from them. It then rewards them, in inverted commas, by affording them a discount. And the source of that discount is, again, as I previously stated, and I don't want to overemphasize this point, the loyalty program contract. The purchase and sale contracts are contracts standing on their own feet. It is, with respect, no different, as Wallace J.A. pointed out in the SCA, to the normal pensioners discount or the Black Friday sale. My learned friend sought to bring the question of a gift voucher into the equation. And in that argument, my learned friend relied upon the interpretation note issued by SARS. In the interpretation note, loyalty or gift vouchers are in fact mentioned as an instance where Section 24C would apply. But one must read the whole of the interpretation note and not only one part of it, because a gift voucher is a typical case where the payment, when the gift voucher is purchased, is a true advance payment on a future obligation. And this is what the interpretation note says throughout. It uses the words advance income. Now, I know that Section 24C does not use the words advance income, but if one follows the history of Section 24C back to the construction example, where a construction company receives on day one a large deposit or down payment, and the end of the financial year then intervenes, and there is no performance in terms thereof yet. That is a true advance payment. it appears that Justice Matopo wants to say something, but I can't hear.
Just proceed, Mr.
Carry on.
Sorry. I'm making the point that if one looks at the history of Section 24C, the purpose for which it was enacted was to create or to offset the inequality for a entrepreneur who receives a large down payment and not being afforded the opportunity to deduct anything from that, whereas in the next year it has a large deduction and it has no income. So, yes.
I'm sorry to interrupt you. Is it open to the respondent to make that submission, having regard to the statement, the stated case, and also what is contained in your heads of argument? And if I can refer you, Mr. Ellis, to volume 6, page 502. Section 24C1 says, for the purposes of this section, future expenditure in relation to any year of assessment means an amount of expenditure which the commissioner is satisfied will be incurred after the end of such year. Has the stated case and the facts agreed with between the parties not brought this case within the ambit of Section 24C, regardless of the nature of the business conducted by Clicks, that it is not a manufacturer, that it is not a builder? Has the parties not agreed that the future expenditure falls within Section 24C? And if you look at footnote 36 on page 502, it records what happened at a pre-trial meeting on the 22nd of March, where SARS had indicated it may pursue the legal contention that the allowance made by the appellant in respect of the purchases that will be made in future does not amount to expenditure, as provided for in Section 24C. So SARS said, we intend to raise that point and we may amend our pleadings if necessary.
Yes.
Subsequent to that, SARS would deliver the amendment, but thereafter withdrew the amendment and expressly recorded that it did not intend pursuing the issue of the expenditure contention. And if we read that with your heads of argument as well, Mr. Ellis, paragraph 37 of your heads of argument. Second sentence, we submit that it is unnecessary for this court to consider the tax treatment of stock in trade or the concept of expenditure for tax purposes. And is that statement not made in light of the fact that that was not an issue that was raised by SARS?
Justice Tron, you are absolutely correct. We are not seeking to reopen the issue of the tax treatment of stock in trade at all. The argument that I pressed, and it is also correct, as I pointed out at the beginning of my oral argument to you, the SARS does not take the view that there was no expense involved in creating or meeting the discounts. All we are saying is that the the three contracts that I have postulated does not satisfy the requirement of sameness as set out in this court's previous judgment in Big G. I'm not suggesting that this court should look into the issue of the tax treatment of stock in trade, because that has been settled over and over again, and it does not need any consideration here. My arguments were not aimed at undoing that concession.
If I understand your submission in paragraph 39 of your heads of argument, Mr. Ellis, you once again say it's not necessary for this court to decide that, but you use that, and it was merely referred to by the SCA to illustrate the lack of a direct link between the contracts generating the revenue and the obligation to perform.
Yes.
And I do believe, and I stand to be corrected, that this, my brother Jafta also touched on this question. Is it part of the test for sameness that there must be a direct link between the contracts generating the revenue and the obligation to perform? Has that question been decided by this court or another court?
Now, I submit that that is no, that issue has not been decided by the Constitutional Court, and but with respect, it has been decided in the SCA, in the judgment of Wallace J.A.
The judgment of the SCA was prefaced on the SCA judgment in Big G and largely followed that judgment.
Yes.
So to a large extent, that cannot be relied upon since Big G's judgment in this court.
I would, however, submit, Justice Theron, that whether or not the SCA judgment was prefaced on its own previous judgment in Big G, the logic of the direct link decision commends itself as an exposition of the relationship that two or more contracts may have in order to satisfy the sameness requirement.
Now, it seems to me that that question, and you refer to the logic of the requirements of sameness, has not been fully ventilated. And I asked Mr. Bloomberg his views on this as well. Is this court in a position to decide that issue, which is an important question, without it being fully ventilated on the papers and without the assistance of judgments from lower courts?
Justice Tron, my submission is that the matter was dealt with in the tax court on the basis of a stated case. That stated case formed the basis of both the proceedings in the SCA and in this court. If the matter is now being referred back to the tax court, I cannot foresee any difference, any different fact that may be placed before the tax court than those facts that already appear from the stated case. My submission is that this court is in as good a position to determine the issue on the facts stated in the stated case.
In
It
that
is-
respect, Mr. Ellis, this court then would be a court of first and last instance on this matter.
No, I submit not. I submit that the facts are before this court. The only situation is that whilst this litigation was going on, this court gave a judgment which altered the test to be applied slightly. But my submission is that this court is in as good a position now as any other court to determine this issue on the facts that are already on record.
So on the slightly altered test that you put forward, that this court set out in Big G, this court then would be acting as a court of first and last instance if it was to pronounce on that.
No, with respect, I cannot agree with that contention. I've made my submissions on that.
Which other court has pronounced on the test to be applied when regard is had to sameness?
Subsequent to Big G, none. No other court has.
Thank you, Mr. Ellis.
Chief Justice, I think, yes.
Yes. I just wanted to find out if you still have submissions to make.
Chief Justice, no. I think I've said what I needed to say. I cannot take the matter further than what I've done, and as was said in the heads. I need to address the issue of costs, of course. My submission is that if the appeal is disallowed or if leave is refused, then this is a typical commercial case in terms of which a costs order should follow the event, and I would ask for a costs order including the costs of due counsel.
Mr. Ellis, what would your submissions be on costs if this court was minded to remit the matter to the tax court?
Justice Tron, I think that the correct way would then probably be to reserve these costs or to make that costs in the cause, if that were the outcome of these proceedings.
Well, talking about costs, isn't SARS an organ of state?
Yes, that is so.
Why then would you submit that costs should be payable to SARS even in the event of SARS being successful? BioWatch?
Yes. The only submission that I can make, Chief Justice, is that the case up to here was driven by the commercial interests of the applicant alone, and that should be enough to make a costs follow the event rather than to follow the normal course of events.
Okay, I hear you. Thank you, Mr. Ellis.
Thank you.
Mr. Bloomberg?
Yes, thank you, Chief Justice. I'll be brief in reply. First, there was an interchange between Justice Victor and our learned friends that framed very neatly the basis on which Clicks claims the allowance. the proposition with reference to the 100 Rand purchase example that we've referred to, the proposition was put to our learned friends that in that scenario, absent the allowance, Clix's tax liability would be overstated by the R7.50 amount. That is the cost of honoring the rewards generated by the 100 Rand transaction. Because Clix knows that in the subsequent year, R7.50 is going to be used to honor the cost of, or rather to fund the cost of honoring the rewards. That is precisely the basis on which the allowance is claimed with respect. Second, the interchanges between, in the course of the interchanges between Justices Theron and Jafta and our learned friends, the point that SARS makes in paragraph 42 of its heads about the degree of sameness not yet being determined by this court was highlighted very emphatically. In the course of those exchanges, our learned friends proffered to the court two different refinements on the inextricable link test adopted by this court in Big G. I'll come to what the refinements were in just a second. But the first point we make is the very fact that the respondent is offering refinements on the Big G test to this court makes the point in paragraph 42 of its heads and paragraph 99 of ours. The two refinements offered were these. The first was the direct link test posited by Wallace J.A. In paragraph 29 of his judgment. Paragraph 20, in fact, paragraph 30. That was the first refined Big G test that our learned friends offered. The second refinement on Big G was a test, and I'm quoting from my notes, my learned friends' words, where the one cannot exist without the other. That is the degree of linkage, so says SARS, that should be applied. Now, the first point we wish to make is the one we've already made. There's an absence of refinement. The exchange shows that there's law to be developed. The second point we wish to make is that if those tests as refined are correct, we submit that Clix satisfies them. If we can start with the one cannot exist without the other, our learned friends test. We've identified in our argument the two components, the two sides of the section 24C equation. Without both contracts, the income side of the equation falls away because one is talking only about income in terms of reward generating transactions. The same applies on the future expenditure side. The future expenditure falls away altogether in the absence of both contracts. If our learned friends are correct in saying the test is that the one cannot exist without the other, we submit that that test is satisfied. The second refinement offered was that in the judgment of Wallace J.A., where it was said there must be a direct connection between the amount received and performance of the contract. We submit that it is difficult to conceive of a situation where the link would be more direct than it is here. When Clix receives 100 Rand, it knows that 2 Rand goes back to the member. That test is satisfied if it is the test. On the topic of the remarks of Wallace J.A. in paragraphs 29 to 31, and moving away from the test of a direct test, there are factual observations made by Wallace J.A. with respect in those paragraphs. The first thing that one needs to do with respect is to contextualize those comments by understanding the topic that Wallace J.A. is addressing. And Wallace J.A. identifies that topic at the beginning of paragraph 29 and in paragraph 31. He says, I'm speaking about expenditure as contemplated by 24C. we've made the point that that is not an issue, and our learned friends have confirmed it. Our learned friends confirm too that and this goes to the point raised by Justice Turan about the abandonment of an amendment. Our learned friends confirm in their answering affidavit before this court, paragraphs 8.1 to 8.2, that the nature of the inquiry in these paragraphs of Wallace JA is a factual inquiry, not a legal one. One cannot, with respect, investigate a factual line that is not an issue. It is grossly unfair to a party. Different considerations may apply when it comes to a pure question of law, but SARS says, and they're right with respect, that this contains factual material. And then to one or two smaller points remaining, a related point about straying from the stated case. Our learned friends were heard to say that the foreign authorities debunked the myth about the nature of rewards and that they in truth amount to discounts. First, we don't read the authorities to say that, but more pressingly, that is not the basis of the stated case. The stated case says very clearly in paragraphs 19, 21, and 27.3 that Clix's obligation is to furnish goods. SARS, with respect, cannot stray away from that. On the topic of the foreign authorities, we cited a judgment of the ECJ and of the UK Supreme Court. We did so in the context of leave to appeal, not the merits. Our learned friends have been at pains to point out to the court, with respect correctly, that in those two cases, the law was different and the facts are different. We agree with that with respect. Those are VAT input cases involving loyalty schemes that are very different. On the order sought, we would ask that leave to appeal be granted and that the appeal be upheld with costs. If we have had an opportunity, we're grateful to the court to consider the eventuality of a remittal to the tax court, and we're in agreement with our learned friends that in that eventuality, the appropriate costs order would be for costs to be in the cause.
Thank you, Mr. Bloomberg.
Yes, it's pointed out to me, Chief Justice, that in relation to a question, Chief Justice, posed by yourself in the course of the earlier debate about the potential avoidance of tax, I think we've covered, or minimization of tax, I think we've covered the ground, but this is a question pure and simple of timing. Overall, there's no reduction of liability. It's simply matching the taxation of income to the year in which the related expenditure is incurred. Those are our submissions, Chief Justice.
Thank you, Mr. Bloomberg. A judgment is reserved and court adjourns.
As the court pleases.
Today's proceedings have been concluded. The host will now terminate the meeting.